Okay, let's get going. How's it going, guys? Good Friday again, and all fired up about this chat we're going to have. I think it is recording, so unlike last week, um, there was a lot of Twitter stuff going on late last night, so I got in bed kind of late because it was a lot of fun debates going back and forth. But I'm rested, ready to go. One of the couple things I wanted to mention is that if you have some questions you want to ask and you don't want to talk, well, you should talk, number one, and request to speak, and I'll do my best to monitor that and let everyone speak. And then send me some direct messages if you have questions and you want to put them in writing. So, yeah, a couple things. I tweeted a lot of stuff this week, so if you want to talk about any of that, just bring it to my attention, and we can do that. Um, the article about CTAs not having convexity with the stock market, that sort of hit a nerve with me because I just really dislike this whole idea that CTAs exist in this world only to be allocated 5 or 10% of the capital in a portfolio so they can somehow miraculously offset some of the big stock drawdowns. And what they're really getting at is, especially in this sort of, well, it was classified as a research piece. It's not much research to me, but what they're really getting at is we need you to alter your parameters, you CTAs, so you'll sell that downside breakout in the S&P at the 50-day low rather than the 100-day low, because that's what's good for us. But of course, 50-day breakouts are not very good in general and probably create a lot of losses. And it's not good for a CTA trying to build their business or just trying to make money. No, we don't care about your program and how it works for you and the business you're trying to build and the clients you have. If you get money from us, we have a specific purpose for you, and that is to offset, first and foremost, offset the drawdowns in our stock and bond portfolio. At the same time, you're trading currencies, commodities, interest rates as well, not just stocks. And this is a failing of CTAs over the past few years because they've gravitated towards longer term systems, which make more money, which are the only thing really making money now. But wait a second, back to what we want you for. And then we're going to write articles that give off the impression that it's a big failure. I didn't like that. Yeah. So, anyways, if anybody wants to pick up the ball on that one or, do your own thing, go for it.
Hi to everyone, very happy to be here, as I always say, and I'm absolutely sure that I will always be happy in such discussions because trend following world and this discussion, these conversations, one of the most important things for me, and so I'm very happy. And okay, let's get started.
One of the things that I was researching this week was I was looking for some empirical research to validate trend following strategies. And it was actually interesting. I turned up a piece from two professors from UCLA Anderson, written in 1993, that was focused on the equity market, so not the futures market, and not exactly trend following, but what they back tested from 1965 to 1989, I believe, were the dates of a buy the winners, sell the losers strategy. And what they found was that companies whose stock prices outperformed for 6 months, and then they subsequently added them to their tracking portfolio. They had a 12.08% statistical outperformance versus the market index. So not exactly trend following, but I think it's just some more confirmation that sticking with the winners and selling the losers strategy works. So, that was my interesting piece of research for the week.
That's pretty good. I was thinking about that. What you what you're saying reminds me of something I was thinking of this morning, because last night I was discussing on Twitter. Niels and Richard, they came up with this idea to create a group of CTAs that they would track that I think they had a good serenity ratio. So we'll choose these CTAs. They have a long track record, and we'll choose and the serenity ratio of each of them or the group as a whole is really high. And this we'll be able to track how this group of CTAs are doing. And this is sort of our industry, the industry. And then later, Rich admitted that, just choosing every one of the CTAs with a 15-year track record, let's say, I think it was 15, is better. And I tweeted that again last night, and he confirmed that. And so that sort of makes me think of a lot of the research that I've done in trend following, and that is it's the general broad principles that do well. And the more you dig deep down to get these granular grains of truth, specifically to make your strategy better, it's a very little payoff. And just some general strategy that buys winners and sells losers, you're halfway home or 90% home. I don't know. But it just seems to me that the crudest rules I could make performed better than the most general idea. And the more specific I got, tried to fine tune these rules, they did worse in the back test and stuff. So I think it's perfectly great to talk about these ideas that in general, this is what you're seeing. And I think that's kind of fits in with the loose pants as well. The digger you deep, the deeper you dig into some of these trading ideas, the worse off they're going to be. We just should all be mostly kind of generalist, believing in diversification, a trend, and taking small losses. And I suppose not capping the upside or not capping it too much, because that's going to be a bit fatal, I guess.
Yes, I agree with this, and I remember that you said in one of Systematic Investor podcast series that you said, as I remember, over analyzing shorts is not a very good idea or something like that. And I agree with this, that we must have our rules, we must understand our rules, as I always say, and we must follow them and be disciplined. And maybe such types of analysis cannot be useful here. I think I like to be open-minded. I like to study something different, but I have a lot of research on my topic, my trend following topic, and I'm absolutely sure that it's the right way. So maybe it's interesting to read about something else, maybe, but not for me now. I have my own way, and I'm sure that it's the best way. And some types of over analyzing this may be really not very good idea.
Hi guys. Hey, for me, this has become like a lifestyle choice. I mean, I used to buy and hold, and it, up, down, live and die by that. And then when I found trend following a couple of years ago, I dabbled with it. And then to pick up on what Jerry said in the beginning, to me, I don't want to do just 10%. I want this to be it for me. This is the way I've chosen to live. This is, even if I have some lean years while the stock market's going up, I'll still sleep better at night. I'll know I'm just better off in general. So just to piggyback on the beginning, that rather than 10%, I want this to be 100% for me. And that's hard when the stock market starts shooting up. The old tendency is to want to jump back in, but then you just got to keep to those rules and keep to that discipline.
I like your words, and I like that philosophy in general, not only because of profit. So I like profit, of course, but not only this, it's because we follow our rules, we are disciplined, we have good rules, we study a lot, and we maybe even suffer during this process. But in the end of the day, we win because of all these factors. And in general, it's I even wrote in Twitter maybe a year ago that being a trend follower is a mindset of a successful person, because a person is have a patience, have discipline, and or maybe he knows a lot how world is organized. I think so.
Hi guys. I want you. I want to have your opinion about what do you think about using trend following principles, but not in a portfolio way, in a CDI way. Like for example, people who are buying or selling or trading a couple of stocks. Do you think that it's still somehow valuable? Like say if you are trading 5, 6, 10 stocks, or do you think that it doesn't make sense since you have to have the leverage, the stops, the huge diversification? Do you think it doesn't add anything to it, or do you think it's at least marginally useful?
I think that I know the right answer here. I'm sure that, of course, trend following principles are unique and it's very perfect. But trend following, like Niels said here, that trend following is not designed so in a way for one market. So if you will have only maybe a few stocks or only one sector, you can be in a drawdown maybe for 7 or 8 years, and it's okay to be so, even if you have a right diversification. So like Jerry said, that if you want to have maximum smoothest way of doing these things, and Jerry said Jerry have an answer to this question in one of the conversations, that straight answer, that as I remember, that if you have you can apply trend following even to one market, and it is okay, but it will not be a smooth ride, and it means that you can be in a drawdown for maybe 7 or 8 years, as I know. So it's not the best way. And trend following, the diversification, for me personally, is one of the necessary part of a trend following. And if we use common sense and we use a little backtest, we can see this. So it's very important to be diversified as much as possible here. But of course, if you have not much money for this, not enough money, I know the situation by myself. Of course, we must have a choice. So to pick up, I don't like picking up something, but to choose stocks which looks more uncorrelated than to each other, to choose commodities that I have said that before, to choose asset classes that don't look correlated to each other, at least. It's another topic. But diversification is very important, and your trend following journey will be better if you will have as much diversification as possible.
Yes, with all that, I agree with all of that. However, we sometimes don't have all of that diversification and assets, and so we have to do the best we can. And of course, it's fine to believe, like we do, that diversified trend following is optimal. And I think it's just beneficial to recognize that you can do trend following on anything, stocks only. I've done it, and you can do use trend following on a big basket of markets, currencies, commodities, stocks, bonds. I do that every day. And that's trend following. It's not managed futures, CTA diversified trend following, and it's fine. Not everything needs to be that or can be that. It's interesting to watch a lot of these stock-only hedge funds crash and burn. The famous ones, the successful ones, are down 40 and 50%. They rode the tech stocks up, they rode them down. So, and then I'm not exactly sure, if they're overall positive over the past 2 or 5 years or whatever. But I just think that you can make things a bit better if you're using the trend following ideas, which are stop losses, trailing stops. You're not still in those stocks, right? Microsoft, Amazon, Google, they're all kind of shorts now. Or, if you do shorts, they're definitely, made the 200-day low or the 100-day low and everything in between. So I think that you'd have to use more moderate leverage, and be careful and just accept those big drawdowns, especially in a situation where if you've ridden those trends, you've ridden them for years, possibly. I look at those charts quite a bit on those FANG stocks, and you could, over the past 5 years, you may have gotten out one time and had to get back in, or not gotten out at all. So you'd have hugely profitable trades, and you have the accompanying drawdowns, no big deal. And plus, you're in the stock only category, and people love that. A drawdown in stocks of 20 or 30% equals kind of like a 10% drawdown for CTAs. So, yeah, you should definitely trade the markets that you can and get as much diversification as you can, and then apply the trend following, and that'll put you in probably a better situation than buy and hold or discretionary type strategy. But you can't always have exactly what you want.
For me personally, there is two things very important. Of course, all factors of our trend following programs are important, very important. But two things, maybe the most important, maybe that first of all, it's risk management rules, and second is a diversification. Because without risk management rules, proper risk management, your account will go to zero, and without a diversification, you can be without a profit for 5 or 7 years. And it's very interesting and powerful tool, diversification, because first of all, maybe not first of all, but it reduces our drawdown with the same risk. We have these benefit of the diversification, and also, as we all know, in catching these outliers, we have more chances to catch a good outlier, and even a few markets that have a good trending period may give us very good profit in the year, and it's really very powerful and interesting. So some markets can be in a flattish way be trading, and only maybe few markets can be trending, and it will be okay for us. So it's really very, very important to be diversified.
Yes, I was thinking about that, about sample size, that it's very reduced if you're doing just a couple of stocks. But I also thought about that maybe if you're following the price and following what other people is doing, it's better than having an outsider opinion, or an opinion based on value, on some other kind of criteria. And I also remembered what I think Paul Tudor Jones said, that that everything is better if you apply a 200-day moving average on it. So I was considering, even if you have very little diversification and a couple of stocks, it would be okay to apply trend following or momentum, or it was very dangerous because of the whipsaws.
I think that I like words of Jerry very much. That when he said that trend following trend following improves even bad ideas. I think Jerry O'Neill said, as I remember, Jerry said that. So it's better for me. Certainly, it's better theoretically. If we're talking theoretically, to trade one market, let's say Tesla, in a trend following way, than to have a discretionary opinion on this market. And for me personally, if I have these two choices, I will theoretically choose to apply my trend following principles. But maybe for 1, 2, 3, it's okay. We have talked about today that we must have diversification, but I think that principles and philosophy of trend following is the best what can be and what I have seen in the market for 15 years. I had a lot of research, and I had a lot of research maybe in different direction, mostly trend following research, but not only trend following research for these years, and I haven't seen anything better, and I'm sure that it's not exists.
First, I agree with Oleg and Jerry. I think it's best to, for me at least, to apply trend following principles to anything that will make things look better. But I start from a point of total total humbleness on how to approach markets. I don't know what's in front of me. I don't know how the market will unfold. And the trend following principles will protect me from most of bad outcomes and let open what good can come from them. But anyway, when you apply a trend following system to a large sample of markets that will yield a large sample of trades, you will notice that you have about 40% winning trades. As Rich reminds us all the time, about 10% of these 40 will really be meaningful for you. Most of them will not. They will be small wins, and the other 60% will be small losses. So when you apply this system live on a small number of markets, the chances are you will have to bite some glass through some time until some market will be the real outlier you're been preparing for all the time. So maybe that can be frustrating because you will have to wait a long time before anything happens, anything good happens for you. That's the reason why I see that diversification is so important, because you're spreading the bets across a huge number of markets. You're in a way saving time. Let's say you would have to wait for 1,000 trades for one be the really good one. If you're trading one market, that can be a lot of time when you get to that 1,000th trade. But if you're trading 100 markets, that time is divided by 10. It's evidently that's not how you should really make the counting of trades, or I don't know, calculator statistics, but the intuition is in that direction.
Agree with this, like this ideas, and I think that if we have a diversification, it's if we haven't diversification, but if we have a discretionary way of trading, sooner or later we will lose all. It's very big probability that if we have our intuition-based system, discretionary system, opinion-based system, sooner or later, I think you can lose all your money there. And if you apply it only to one market, a trend following system, yes, of course, you can be in a drawdown for 5 or 7 years. and you can have maybe a big drawdown, but you will not lose your money if you have a good risk management rules. If you have good risk rules, you will not risk your money or lose your money. And if you are a discretionary guy, I think it's probably you will lose all your money. I'm not an expert here, but I feel so.
So I'm based in Europe, in London, and so in terms of diversification, here it's possible to use CFDs, which is a product suite basically where you can trade $1 or €1 or £1 per point. So what that really mean is if you're having a small account size like 100,000 or so pounds, you actually can trade like a trend following fund who's having 10 million pounds basically because you can size your positions in such a way and diversify around 60 or 100 markets easily, and so that's why I was always keen how the traders in US are diversifying, because I know that the CFDs are not available to US traders, and so does this mean that you cannot trade 70 or 80 markets perhaps if you're trading with a small account size? So I've always find it interesting and wanted to share that trading with the CFDs has a unique edge if you're living in Canada or in Europe. So I just wanted to share that. Thanks guys.
Yeah, thanks for that. There's a lot of there's a handful of people that we know that trade these, and they talk about them. And when people get started, I think they start with the stock market, and then you can trade different stocks. And I'm sort of teaching some of my sons to open up a stock account and start applying some trading and trend principles, money management, and then they have access to all the stocks. And there's ETFs that fixed income ETFs, bond ETFs, and commodity ETFs, crude, gold, even currency ETFs. So it's not a bad way to get started. And you can even do shorts in those as well. So I think that that's what I've been encouraging my sons to do, and it seems to be going off okay. And they're learning, and with small amounts of money, the trading ideas and principles. And so far, I think one of them the other day tried to short the 10 ETF. And 10 is, it's hard to trade. I've been trading LME since the late 80s or early 90s. And so 10 is hard. And so 10 inside of an ETF, that was probably pretty hard. So he was not able, Fidelity would not let him go short 10. So, it's all about doing what you can do in the markets you can do it in. And I know it's going through a lot of people's minds as these CFDs, I think that's what you call them, they're expensive to trade. There's issues with ETFs as far as liquidity and fees as well. I know. And so another thing I wanted to mention from the original question about comments about trading trend following with stocks only, at the very end, I forgot who asked the question. Maybe it was Anish, but he made a comment about trading stocks only and extra whipsaws. So I don't think it's necessarily extra whipsaws. You've got this ATR stop loss, whether it's based on 2 ATRs or 10 ATRs or anything in between. You've kind of gone through the back test. You've optimized if it's going to be 2 ATRs or 10 ATR stop loss or something in between. So you're going to use this for all the markets. And if you're only trading stocks, I've just never seen from a whipsaw point of view of taking the small losses, that stocks have this unique characteristic that you're going to get whipsawed more often or get out of these losing trades if you're using sort of this optimal parameter for your stop loss. And of course, if you're meaning that you're getting whipsawed by on the winning trades where you keep getting out of these great trends and they go back to the highs, you got to get back in. Well, that's can be a situation of just trading too short term. And that's going to pop up in every market, currencies, commodities, interest rates as well. So I haven't noticed any kind of, and this, I know a lot of people disagree with this, but I personally haven't really noticed too much of a difference between each market sector. Stocks are so much different than everything else. I really haven't seen that. There are problems with your system that you'll keep getting stopped out or you'll give back too much profit or whatever. But in my opinion, that's just going to be universal across all the markets. And as good trend followers, we're supposed to do this back test and approach these markets as if they're all kind of the same. We're using the same strategy, the same parameters, the same breakout or moving average on all the different markets, longs and shorts. We're not optimizing per market or for longs and trading the shorts differently. So honestly, I probably have never put much emphasis on trying to really see the differences in the back test as it relates to the different markets and sectors.
To the previous comment about trading vehicles, so there's minis, but then there's also micros in the U.S. where, depending on the broker, it's like a $2,000 margin requirement on micro crude, micro index futures. So that's available in the U.S.
When we talk about diversification, and I am the direct benefactor of Jerry's advice. I remember a few months ago, he said, "Don't tell me that I didn't tell you." So yeah, thank you, Jerry. And also, I want to bring up one topic about. I know as a trend followers, we are all disciplined, and in terms of break the rules, can we? Can you provide any advice? And for me, in this volatile situation, like a stop loss for me, it's very counterintuitive and very exhausting. So, I mean, I believe probably stop loss should be at our own discretion. Do you agree with that? Thank you.
My personal opinion on that is with for instance the stop loss that you personally I think for me it's important to have a systematic way to put a stop loss. So obviously if it's like an ATR, I don't know what type of ATR, but that you use it consistently so that you price your trades consistently and your position size as well. Otherwise you won't get as much benefit from the system, in my opinion, as you would like. Um, and in terms of like breaking the rules, personally, um, I really believe that breaking the rules should be like 0.0111 percent of the time. Like I really think sticking to the system is really important to make the strategy work, because that one time you break the rule might be the time your system wanted to catch the outlier, but you just your personal emotions kind of caught up in that and you didn't catch that outlier. So I think breaking the rules should really be like a very very exceptional case. But I did hear like a while back in the clubhouse that in certain times when there's been a big drawdown, that there are trend followers or people that do the trend following strategy, that they do cut their trade size based on, because the drawdown is too much. But personally, I try to avoid it as much as possible. But that's my opinion, of course.
I mean, I think that's right. I like all of that. That sounds good. Oh yeah, that's the ultimate rule. The ultimate money management rule is you want to, if you get into these situations where you're having these drawdowns that are very unusual. The problem is I used to have these drawdowns and they weren't that were too large, for me and my clients, or psychologically or practically. And then I was too frequently making cutbacks in my position size which is, the perfect rule. When you have these drawdowns, then that's what you want to do. You want to cut back your current positions and your future trades so you can continue to implement the rules. But if it happens all the time, like, every 6 months or every 2 months, maybe you're just trading too large. And that's what I was doing. You need to trade smaller. Anything that deviates from your entry rule and your exit rules, it's something to try to avoid, and it's going to make less money. And I think that's the big idea. We can't predict these markets and what's going to happen, and we can't gain any kind of knowledge or heads up because, wow, look how weak it is. Look how this market is sold off this week. It just portends that the trend is going to end. I mean, so, well, let's do something. And so I've done that, and I thankfully just never seen it work very well. And so I think that's the other rule. You don't want to do these discretionary trades unless you have to, because you'll just end up making less money. You'll make less money by doing non-system trades. But sometimes you do want to exercise this one rule risk management of reducing your position so you'll stay alive and stay in the game. And if your clients are okay with the 50% drawdown and you're okay with it, then that will inform you on when to utilize that cutback rule. If you get freaked out with a 12% or 15% drawdown, then that's going to inform you again. But there's one of the most important ideas for any trader is the initial choice of leverage, your initial choice of your risk budget. It's very dangerous to get in there and overtrade, not realize it, or even realize it and say, well, I'll pull this out of the fire just in time. And I think that's something you don't want to do. You want it to be very boring. You're buying these breakouts, you're selling these breakouts, you're doing every single trade just like your rules say that you should. And then every now and then, when all hell breaks loose and you're over, on too many longs, or like I'd say the last time I saw this in my own system was when January, COVID 2020. So you want to cut back, and then as soon as you realize you're still alive, you want to immediately start doing those trades again. And this cutback allows you to responsibly continue implementing your system. And then I know I have said another thing too, in contrast to like CTAs who like to manage the volatility and manage every trade. And once the trade gets too volatile or it's making too much money, they just cannot control their desire to take a profit or reduce it and blame it on too much volatility equals risk. And so rather than a daily diet of these stupid rules where every time the ATR pops up a bit, you've got to reduce your position. And even worse, if it goes lower, you have to increase the position. I don't think it's, if you've got a monster profit and it's really bothering the hell out of you and you can't even sleep at night, but if this is like the biggest trade of your life, if you just sort of say to yourself, I've just got to get out of 10% of this trade, I don't think it's the end of the world. Now, I've said almost these exact words, word for word almost. I mean, I've been doing this for 39 years, okay? These are not new ideas to me. And then people have accused me on Twitter of being too discretionary, when in fact, it's the opposite. Some of these rules that people come up with, vol management rules, this is systematized discretion. That's all it is. These are bogus, non-robust rules. And so what I'm saying is, rather than doing these type of rules and giving yourself a pass because you can call it a rule every single day, once a year or once in your career, if you've got Tesla and it's just skyrocketing in a parabolic way, and you say to yourself, I've got to get out of 5% of this, Okay, it's not the end of the world. It's an outlier. You crushed it. Okay, comma, you'll probably make way more money not doing it. Or not way more, but a bit more. And then you can pat yourself on the back for being this human who acts like a computer, who always follows your system, which I think that's something to strive for.
And I think I like very much what Jerry said right now, and always, almost always, I like very much what Jerry says. And I want to say that if a person don't want to have a boring process, it's a very good idea, I think, for me personally, to have a backtest, to have a massive backtest. And I think in a trend following space, we can do a lot of very interesting things. We can do a lot of backtests, a lot of different thoughts. For me personally, so. But not doing stupid discretionary things, ideas. If you have a discretionary idea, as I have said a few seconds ago, do a backtest for 30 years, see is there any evidence. But remember, I think all people must remember that our system, trend following system, is adaptive. And I don't know any other system strategy that can be that have so much ability to adapt. And trend following system works with a unpredictable future. So we have it's good for us, unpredictable future events like different crises, and we have seen a lot of such events in recent histories. And we can deal with all this and be very successful. And some strategies like artificial intelligence, for example, and Niels said that if these strategies, they deal only with the past. So you can do a backtest, and this backtest will be perfect. But in the future, the environment will change, and that strategy that worked maybe for 20 years, it will stop working, and it will ruin your account because it's not adaptive. And also there is a very important factor for me personally. When I did a backtest in short-term space a few years ago, I was a short-term. I began as a short-term trader, and I want to say here that backtest can look in very good way in short-term momentum trading, but in fact, when you execute these trades, it can be a very different situation in execution this. And we also must understand all this stuff.
Oh, okay. Okay. Hi, Jerry. Hi, everyone. Too many issues here. I want to speak about the diversification. It's different for CTAs and stock traders. For stocks, you try to minimize the unsystematic risk when you diversify. For CTAs, you try to catch the tails, left or right, depending on whether you are short or long. So this is one issue that people confuse when they are talking about diversification. The second, Avi brought up the momentum anomaly that was in that seminal Columbia paper in 1993. This is the cross-sectional momentum. CTAs are price series momentum traders for the most part. These are different things. The price, the cross-sectional momentum premium is diminishing. And if it was not for QE, it would have been gone. There couldn't be any since about, let's say, 2007. There was a nice paper by Susan Huang and Alexander Rubesam It's 968176 in SSRN that they documented this. So we're talking about different things. Trend following means different things to different people. I don't want to talk too long. If you listen to Jim Simons in a TED interview in like 80s and the 70s, when CTAs made lots of money, fortunes, basically, the turtles and everyone else, you could use a 25-day moving average and make a lot of money. But then there was a regime change in the markets, and now markets are mean reverting to a large extent. So to summarize, my approach is to use cross-sectional momentum, price series momentum, and also mean reversion. I also use long short with equities, and now I plan to do it with factors too. So yes, trend following is the only way, as I wrote in a book back many years ago, to make good money in the markets, but it's not easy. You get paid not so much for the back test or the methods or the indicators. You get paid because you are a good trader. You are a good risk manager. And this is why you get paid with trend following. And experience is what counts. This thing cannot be taught. You cannot teach people to be trend followers. I think Jerry will agree. Thank you so much, guys. Interesting.
I just wanted to say there's one thing you mentioned about the regimes change. I just realized, like you mentioned, using a more shorter term strategy, trend following strategy, and that making money, and with the regime change, that not being as viable. And I think that's the reason why longer term trading has so much benefits, because when you have longer term trading, the regime change is not negatively impacting your trading strategy, because that's already integrated in the trend following. So it will pick up the regime change. But obviously, if you're doing a short term, then that becomes a problem. So that's the only point I wanted to highlight there.
Yeah, but listen, I understand what you're saying. But in the US stock market, there hasn't been a long whipsaw since the mid 60s to 80s. And after the 80s, all the bear markets and corrections ended with a sharp uptrend. Now look what happened in emerging markets from 2011 to 2017. There was a long whipsaw and no trend following method worked. They generated very large losses. So this is another type of regime change that can happen in the markets. And this doesn't happen so much in commodities, but this is the risk with trend followers who decide to take advantage of the momentum premium in stocks. Okay, that's what I'm going to say.
Yes, we're talking about a similar topic today, and this is diversification. And that, of course, if we trade in one market, and especially if it's in a short-term space, we will see some kind of issues here. And of course, this is that as I said today, that our system, trend following strategy, trend following philosophy is adaptable philosophy. And so it's today we mentioned that it's very important that by Jerry Vowell, as you remember, it's very important. It's much better to be a long-term trader, and of course to trade different. I want to say to trade different sectors, and all trend followers know this, because professional trend followers, that if we trade only stocks, it's only commodities, only bonds, only currencies. It's once, but no, I want to formulate it more clearly that financial instruments are more correlated to each other than commodities. So we have commodities. It's most uncorrelated return streams. So, and we have stocks, we have bonds, we have currencies. And it's very more probability that we will see the similar picture in bonds in one moment, in one period. In bonds, on financials, currencies, and maybe the stocks markets, then in commodity space. And I want to say only here that this is much better to take as much more markets as possible that also uncorrelated than to do discretionary things, and then to combine with different types of trading, to combine with mean reverting, to combine with maybe artificial intelligence, do filters, and like Jerry said, in such way you can filter out of a big trend, and so on and so forth. So if you have enough money, take more markets, more different markets, and we can trade. If we are not a big CTA, we can trade a lot of less liquid markets, like maybe milk and other markets, and it's very beneficial.
Yeah, thanks for coming on and joining us, Mike. I follow Mike on Twitter. He writes a lot of good stuff. I follow him very intensely. He's really funny, puts out a lot of good research and analysis, and tries to keep people straight on Twitter. So it's a lot of fun. I just wanted to comment about Simon's. I saw that TED Talk that you pointed out, and I had the same experience. So when I started in 1983, we traded very short-term trend following with lots of leverage and just 20 to 25 markets, let's say. And it was very profitable. And then we started to notice that in the late 90s that we were having difficulty making money. So we just sort of wrote it off as, well, there's too many trend followers, and we needed to extend our look-back period from 20-day breakouts to 100-day breakouts. Now, this is kind of cheating, and this is kind of shortcut. Okay, so now you can no longer use these 20-day breakouts, but now we'll just simply go to 100-day breakouts, and everything's going to be great. Well, it's going to be profitable, but it's not going to look like the old days. It's going to be a bit of a buy and hold, more so sometimes. Now, if the trends keep going up and up and up, and the multi-year trends, and you're making tons of money, then this similarity to buy and hold is not so bad. But the problem is that even though it's still a profitable strategy, and it wasn't just the long-term parameters became profitable. When we did our back test, they were always profitable. They were more profitable than the short-term breakouts. But now there's more to it than just profitability. There's risk as well. And obviously, when you start having the longer-term look-backs and you're staying in these trends, because in the longer-term look-backs are working well, they're working well because the markets are more choppy than they were in the 80s. And you don't want to get knocked out of the trend and have to get right back in at the highs all the time. So that's great. But when the trend does reverse, you're going to have these bigger drawdowns. And that's sort of this unfortunate compromise that in order to have a profitable business and participate in the trends in the commodities, currencies, interest rates, and bonds and stocks, you had to, this is the choices that you made. So a lot of the larger CTAs looked at that and said, well, okay, we'll trade these longer term parameters, but these drawdowns and this volatility is very uncomfortable. So we'll simply just have an overlay of risk management. So if the volatility on an individual trade, or volatility on the portfolio gets higher than we like, or the correlations amongst the markets and sectors gets higher than we like, then we'll just exit these trades, hopefully near the highs, and this is what we'll sell, modified trend. We're no longer staying in these outlier trades till the bitter end, because that's going to get really nasty. I've been there. We're going to overlay this wonderful, beautiful risk management, and we can have our cake and eat it too. And so that also has negative effects that we've talked about on the space a million times. Over and over, we talk about it. So there is no secret sauce. There is no, or maybe I don't know of too many or any compromises and choices that don't also have some negative features to them as well. So just to finish, yeah, this is what I wanted to say. I feel like to a large degree, we get paid for sitting through those drawdowns that's difficult for other people to sit through. And I keep telling people and clients, we take these small losses, we're preserving capital, like better than anyone. We have tremendous diversification. But yes, we are kind of shifting this risk from capital loss to big volatility with profitable positions. And you would think, oh yeah, this is fantastic. This is great. Thank you for doing that. But no, they don't thank you, because when crude closes on its high and they look at their statement and they're at equity highs, that money belongs to them and they want that money. And a lot of CTAs have redefined that drawdown from a peak in crude or in an open trade profit as a loss. So taking small losses is not just limiting your losses to 20 basis points. It's the drawdown on any trade. So that's what I reject. You can't do it both ways. You've got to say we protect this capital, we're taking these small losses, but in order to maximize our profit, we're going to have to sit there with some volatility. Like there's already been big sell-offs in crude, like a month or two ago. I'm sure a lot of them got out or reduced their position because the vol kicked up. I still have my entire position. Now, is it going to work out for me better? I don't know. Well, we have to wait and see. But it is not fun to have that volatility. And I don't like it any more than anyone else. I wish there was an alternative that was better than what I'm already doing.
Yes, and we can see a lot of different markets, wonderful trends. For example, I have told you about cotton trade, my cotton trade, and maybe a week or two I was looking at this cotton chart, and I told you this before in the recent episode of our discussion that I looked at this and I thought that only because of Jerry and Niels, I handled all this pressure, and it wasn't even a pressure for me. All this cotton chart, it wasn't a pressure. It was okay. And now I see that I'm a big winner there. And it was okay because I knew that I'm following the process. I'm following the rules. So I'm doing what I must do, and we can see a lot of evidence of this. But of course, there is such a funny maybe moment that when maybe not funny when for example I look at the chart for backtest 1 month, or for backtest 1 month period, maybe it will take 1 minute. But to handle 1 month drawdown, it will take 1 month, and it will take a lot of to handle a lot of different opinions of my investors, and so on and so forth, or my friends or my relatives or something like that, that I'm a bad trader, and it's another situation. So we must, as I always say, to learn to handle this, and all will be okay.
Jerry and Michael, can I ask you guys, what do you think is the cause of the current mean reverter characteristics of the market, and if you think that would be a permanent issue, or if it can go back to how it used to be, if it's because of having many trend followers, if it is because there are not so much retail traders anymore, and if there's a preferred way for you to measure in some kind of mathematical or statistical way how the market is mean reverting now.
May I chime in? I would think the mean reverting market is a combination of things. Obviously, it's hard to predict which one is more than the other one. But one of the things is obviously the central bank, in terms of the measures taken to obviously dampen and reduce the interest rates. I think those measures and kind of the bank to kind of make sure the market is stable. Those measures kind of dampened the wild swings, because anytime there's a wild swing, obviously they jump in, just like in the financial crisis. There were measures taken in to obviously reduce the losses. One other thing would be maybe the bailouts, and so there's a lot of measures coming in to make the market stable. But making the market stable means that there's not as much outliers than before. I think there's many more other factors. There's obviously a lot of traders that obviously use the mean reverting strategy, so that obviously reinforces that strategy. But personally, with all the factors involved, which I've maybe missed out on, I think in the next years or decennia, I think this will change. I think we're going through a regime change. It's obviously hard to predict. That's one of the mantras in trend following. But I think there's definitely a regime change where now you're seeing the inflation going all high, and the governments are not able to stabilize it as well as before. You know what I'm saying? So I do think there's a big change happening right now. And personally, I think it will favor the outliers on the right tail side. But it's hard to predict, of course. So don't hold my word for it. I'm letting the strategy do its work, and go for it.
Prediction, of course, it's not our job, but some experts which I respect, it's maybe Mark Jabrzynski or some other guys that we can hear in Top Traders Unplugged. And as I remember, maybe I'm wrong, but as I remember, Neil said that now we are facing the situation like in 1970s, 1980s. So we see the globalization processes in the world, and so it can be a very good regime for trend followers. But mainly for me is maybe a main thing that I know that my strategy is a right strategy, and sooner or later I will have profit, and all the logic, all the evidence show this. It's maybe I focus on this. I focus on the strategy. I don't focus on something else. It's very interesting for me. It's really interesting for me to listen really good experts. It's not much good expert here for me personally. It's interesting. But first of all, I focus on my rules to trade, my self-discipline, my risk management rules, my diversification, to be uncorrelated as possible with that money that I have, and so on and so forth. And without this, it will not be a good, profitable, long-term trading process, I think so. And without analyzing the situation in the world, it can be very good trading process with ignoring all these issues in the world. I think so.
Yeah, hi. I don't think serial correlation is coming back to the stock market. Never. It was too good to be true in mainly the 60s and 70s. There is no explanation, but my opinion is that it was due to the dominance of the value investing I have many articles in my blog about this phenomenon. It ended around 2000. And since the markets are highly mean reverting, just to give you an idea, the one lag 252-day autocorrelation of returns of the S&P 500 goes up to 0.4 in 1970. And then during the COVID crisis, it went down to minus 0.6. Markets got so mean reverting. Now the commodities are a different story. That's a very complex market. Actually, the notion of mean reversion and momentum is kind of blurred. It's not very clear what's happening there. And but in the stock market, I don't think it's too good to be true. It is arbitraged immediately by algos, specifically for those. Yeah, go ahead.
No, go ahead speaking. It's interesting. But I want to say only that maybe we must not. I don't know truth it's or not, but it's very good to be, as I said before, it's good to, you have interesting thoughts, but I think we must focus on this, that maybe the markets for us, for trend followers, are the same. We apply, not markets are not the same, of course, but we apply the same rules, and these rules are universal. And maybe for me personally, I don't think so much of these markets been. We can see, for example, we can see some markets that had for many years that had no performance, and now these markets are, I'm talking about commodities markets now, works perfect. And we see that Neil said that for 16 years stock market in way of buy and hold way, there was no large movements, and it wasn't performed at all. In fact, for 16 years, from, as I remember, from 1958 to 1964, and we see such things in the markets. In all the markets, we see the periods of performing well and the periods of underperforming. And but I want to say that if we talking about the prices, we can, especially in Russia, where we have large inflation, maybe you can go, you can ask a person on the street, every person, how do you think, do prices have ability to change or not? And every person will say, of course it change. Prices always change, especially if we are talking about maybe real estate prices and commodities prices. It's raising in Russia, but of course it changed. And here is a situation that prices have ability to change. And when we are talking about particular sector, particular market, maybe we are diving too deep and overanalyze, like Jerry said something similar, maybe that maybe we, for me as a trend follower, it's not necessary for me personally to do this in my trading activity. I wanted to say only this.
I may have misunderstood what some people were saying, but one of the things that I have noticed that, I was talking to, I did another podcast yesterday, and this guy really got me going. He was like really making me feel comfortable. And I wasn't drinking red wine either. So, but I was going on about, you really don't, of course, I don't need to say it's in my opinion, of course, all of this is just my opinion, but my experience and my back testing, and my training, I just wouldn't try to ascribe characteristics to some of these markets because, you just, the only thing we are sure of is that well, we're not even we're not even that sure. But the only thing we should really rely on is just applying these entry and exit rules and following these systems, and it may work out in the future for us. It probably will. It has for me. So, but in between that entry and exit, there's really no additional information. There's no sign that the market is going to trend our direction or we're going to have a loss. And I've just noticed that, it's just endemic in all these markets that regardless of the fundamentals, we have tremendous inflation. The interest rates have got to go higher, and we're going to be in a recession. Daily market price action does not confirm these ideas. We get these big rallies in the bond market, in the bond futures. We get these big rallies in stocks, and then all of a sudden we get the big, huge sell-offs again, and they go back down to the lows. And so this amount of choppiness and price action that does not confirm the long-term trend. If you go back and look at all the trends that we participated in over the past year and a half, there's been violent reversals. Then some of them kept going. We got out, but most of them just waited to shake out as many people as possible, and they just go right back to the highs. These big up days and big down days don't mean a darn thing, especially as it relates to giving us a heads up on whether we should follow or not follow our rules. And I just think that this is just part of the game. There is I wanted to bring up one thing. I know that we need to get Mike Harris and Richard on the spaces at the same time, because I used to sort of agree that, because I was sort of raised, taught this way, that in 1983 they're like telling us that, well, maybe there's too many trend followers, and I'm like, holy smokes, what am I doing here, right? And so there was just, from day one, there's just this worrying about how many, that it's just ipso facto, if there's too many people doing trend following, then the results are going to be poor. But then Rich, who I respect as much as anyone, Rich Brennan, he says the opposite. We have this mean reversion. We have choppiness in the markets. We have to trade longer term because there's too many convergent traders, not too many divergent traders. So I just throw that out there, that one of these days, hopefully we get Rich and Michael Harris on at the same time, because I think they're more equal to each other in their math skills and quant skills than me, of course. But I think that's a very interesting topic for the future. Morning, George.
I remember having this discussion when Richard on Twitter, I think it was a year ago or something, talking about especially this topic, having more convergent traders reinforces the convergent regime, and having more divergent traders does the opposite. I think what we discussed, and if I can juggle my memory, it was in a case of almost like a reinforcing case, where obviously if you have more divergent traders, they will all go for the outliers more. And by going more for the outliers, you will have more swings, almost like that. So the volatility, I don't know if volatility is the right word, but the swings will increase because everybody's going for the outliers. So if we swing to the right, there's more people jumping in, which will reinforce and go that way. And so then obviously if you have more conversion traders, you do the opposite, because anytime there's a kind of an outlier brewing, you have all these traders jumping into, or their strategies to jump in and dampen that. So it's almost like a frisbee or like elastic, where you jump in between.
I don't want to steal Mike's thunder, or God forbid Richard's thunder, but I think what Mike was trying to get at is the fact that over time, if you wish, the speed of the market changed, and the ability to ride certain trends that you had back in the 80s sort of waned and went away, and probably went away for good, because some other traders emerged, and now those guys, namely the high frequency guys, are so fast that they sort of suck up all the short-term trends. So for anybody who doesn't have that in technological capacity, the only thing you're left with is looking out a bit, further and just go for slightly longer time frames. And so in that sense, I do subscribe to what Mike is saying. Is really hard to see the good times of the 60 rolling back simply because technology sort of has made that opportunity go away. But that doesn't mean that there aren't going to be any opportunities or any good trades for trend following, or trend following is dead. Nor it will mean that I think is a battle of how many you've got on one side versus the other side. Market making is all about that. I mean, you have to take whatever orders come in as they come in, and then lay them off to brokers or the street, and trading will always be about that, regardless of the initial intent of people. So I don't think there's an optimal amount of trend followers versus reverting people to just define the opportunity set. The opportunity set depends on other factors.
And then you have the CTAs like me who say, you can't apply Sharpe, you can't use volatility when measuring the risk-adjusted returns of trend following, and so we shouldn't be put in that category. So we're making money, we're having these big drawdowns, it's freaking people out, and then we are trying to convince everyone that we should not be held to these same standards because hunting for outliers, hunting for trends, trend following, it's non-normal distribution, and you're going to get this big volatility on the profitable trades, and we should be let off the hook on that. So this is where we are. And none of these strict rules and this scrutiny is applied to stock traders.
Okay, I'm going to give you something to take away from this, since we are here, and Jay is very good host. If you look at the percentage of down days followed by up days in the 252-day period, you will see that, for instance, in the gold futures, near the top of the trend, of the uptrend in 2011, I'm looking here at my screen, it was like 70%. This is maximum mean reversion, because in momentum markets, down days are followed by down days, and up days are followed by up days with higher probability. So now, for instance, what happened in stocks? Let's plug here SPX at exactly the top, or before the top, or before the top started forming in 2022, the percentage of down days followed by up days in a 252-day period for the S&P 500 was like 71%. When this indicator gets to extreme levels, something is happening, like maybe a trend reversal. Okay, maybe. There is no indicator that's 100% right. So these are simple things to look at and try to understand when there is a regime change, a trend change is coming. Because now the markets, due to all these algos and high frequency traders, as I think Bruno said, are very difficult to trade in the short term, and trend following is a way to try to ride the waves. Of course, people diversify to limit, the volatility of the equity curve. This reduces the annualized return, and now we no longer have alpha in the trend following business, but we have leveraged alpha. the idea is to have a system that will have low drawdown and a reasonable annualized return, and then you can leverage this on top of the leverage that already exists in the futures. So this is my idea.
And Mike, do you also think that there is an issue that many retail traders are not there anymore because they've been wiped out, and that trend followers in the past also got the returns from them?
Yeah, this is true. It's simple. In the past, when I started trading, I started as in fixed income. Okay, I didn't start as a trader. I was working in fixed income, and I was doing portfolio optimization for bonds. And then I got, by accident, some trend follower asked me to backtest a system, and I got by accident into this field. So that time, trader meant trading futures. Listen to this guy. The young ones, trading meant trading futures. There were no stock traders around. Stocks were for investment. Then all these platforms, the online platforms, were developed and democratized, trading for stocks. And there was a massive switch from the futures markets to stocks. And CTAs lost that liquidity of uninformed, compulsive retail traders that provided the profits. Then from 2000 to about 2021, the annualized return of the top 20 CTAs, the top heavier names with a large AUM, was like 2.5%. Of course, there is a distribution. There were people with high returns and people with that went bust, but I'm talking about the average of the top 20. So yes, when people say I'm trading now, they mean stocks and lately crypto. In the 80s and 90s, trader meant I'm trading bond futures, currency futures, copper, heating oil, orange juice. Yeah, very good point. Jerry will agree. I'm sure.
Well, in light of the past, I would say the last year and a half is probably the best period for trend following I've ever seen in my 39 years. So I'm happy that it's coming back. And we've had this period, but I don't think it's a done deal that we couldn't revert back to more hard times. And I just wanted to say that, there's been a lot of people who are very concerned about trend followers not having good performance. And papers were written, AQR's paper, and it was simply, and most of these papers had the same conclusion, that trend followers suffered because there weren't very many big trends. And so they blamed this lack of trends on the Fed, zero interest rate policy. And so now that seems to be breaking open and things are different and we have inflation and maybe we'll see less manipulation from the Fed, that now we're seeing these markets that have been bottled up for all these years producing these trends. I think it's perfectly fine to acknowledge that and say, okay, fine, you haven't had these big trends. And that's you've got to have at least 5% of your trades need to be, your profit's going to be generated by 5% of your trades in these big outliers. Well, that doesn't sound that reliable to me. So maybe you shouldn't have chosen a strategy that relies upon so few trades. That's a fair criticism, but it has worked for a long time, and now it looks like it's coming back to working. And I've always just been unsure as to how to formulate a good opinion on whether we need these retail traders, whether we certainly have made a lot of money recently, and I doubt if any of these profits have come from these poor traders who are short soybeans and short corn, because this is where I'm making all this money. And then, so I think that these trends have existed. I think they'll continue to exist. Crazy things happen. We're there. We latch onto these. We just need to have these big trends happen, and hopefully they will continue. I just am very confused as to how this all revolves around retail traders. Or then other people will say, oh no, we need to know where this profit comes from, and it's coming from the hedgers. Hedgers are the only ones that who are willing to lose on these trades and take these positions. They own the cash. They're willing to lose on the futures. And I'm like, okay, maybe. I don't know. Is that true? I've sort of just always just written it off as crazy things happen in this world, things you can't predict, wars, famines, droughts, pandemics, and these things will produce trends, and they could be bumpy and volatile, but get on board, hang on. And I just don't understand logically, oh, wait a second, but you also have to have the retail guy. Or wait a second, you also have to have the hedger. Somebody has been losing a lot of money on all of my trades since November of 2020. I don't know who it is.
I want to say that, of course, we don't like to predict anything, but we predict, for me personally, I like to predict effectiveness of my system. And what we have seen, what we have faced in previous 2 years, we have seen very good trends, perfect trends, especially in commodity space. We have seen all this, and all this was predicted by Niels, by Jerry, by Moritz, and I'm listening. I have a habit to listen. Top Traders and Block Systematic Investor Series. Almost every day, I have a habit to listen to this, and again and again. And we see this prediction that real good trends. It was the situation in 2018. There was a big drawdowns in the industry, and Niels and Jerry and Moritz said that it's okay. It's only a drawdown. It's only a period. And Niels often said that we can see in a history that we face such types of drawdowns before very good trending periods, and we have seen all this in the next 2 years. All this, and it was so, and it will be so. And like Niels said, that trend following worked when there was maybe 200 years ago, when there was no trend followers actually, and trend following continues to work when it is a lot of trend followers. So it means that for me that it's a very powerful tool, very strong, very powerful tool, instrument for all of us. And so, and as I have said before a few times, that here's a question: is the prices changing or not? Of course, if a person thinks that prices have no ability to change, according to this logic, trend following doesn't work. It can't work if price is not changing. But if prices will lose the ability to change, I think we will lose the market. In all the markets, in how we understand it, for few thousand years. And I don't see it to be possible. I don't understand how it can be possible, a world without a market. So, not working, trend following equals for me no trading in the road, maybe even no retail trading in the road. So, in this way, I see a perfectness of trend following, and I'm sure that it's based on a laws of nature, on a general law, and we apply universal general rules for all the markets, and it works in a very good way, and it worked, and it works, and it will work, and we only see periods when it works better or periods when it works worse. But as Neil said, that for 10 years, from 2010 to 2020, people call it a lost decade. But in fact, if we look at performance of some CTAs, it's not lost. It's a good performance. So it's perfectly fine.
Jerry gave some food for thought. I think some profits may be coming from ETN retail investors and also options players. And there is a lot of this going on now. The volume has increased in those ETNs. Some of those, they track very poorly the underlying futures. And these retail traders, they actually get a very bad deal. So this is another source of profits for CTAs that didn't exist in the 90s and the 80s. To wrap up my rants here, I think the commodity cycles, they last for some time. I think there are a few good years ahead for CTAs. There is no barrier to entry, but the experienced ones like Jerry and the AQRs and the turtles in general and the big 20 will do very well in this environment because they know how to manage risk and positions, and maybe will last for a few years. So it will be good. Okay, guys, thank you very much. Have a good day, everyone. We'll talk soon.
Thank you.
Thank you, Mike.
Thank you, Michael.
I had one notion or one thing to add that just came to mind in terms of if a strategy is working or not. The trend following strategy is characterized with a low win rate. So the first question is what is characterized as not working? Because the strategy itself is typified as most of the time not winning. If I take it literally, so most of the time I do expect the strategy to be losing because it has a low win rate in the first place. Whereas with a mean reverting, obviously, it's in my if it's my interpretation there in that sense that working is you gaining a profit. That in mean reverting, the win rate is quite high. Therefore, it's winning most of the time, so it's working most of the time. So I think it's the first question would be what defines working, and in what time period are you looking at? Are you looking at 1 month? Are you looking at a year? Or are you looking at a 5-year track record? And depending on that, if you're looking at the long-term track record, then you will, personally, I do see that trend following is winning. Maybe less than before. It's gaining now, but it's not been losing really. But it really depends on how you look at it, and also depends on which company. So what data you're looking at. Like, is it a pure trend follower or not? So there's a lot of open questions there that's unanswered.
Oh, I love to answer unanswerable questions. So now, I don't know if you listened to the last podcast I was on with Niels. you should go and listen to that because we get into this really fun topic. And then I had brought it up with Niels before. Then when Richard gets on with Niels, they kind of both say, no, Jerry's wrong. It's not unheard of for me to be off base, okay? But then, so I was really looking forward to talking to Niels again. And it was on this subject of long-term trend following, classic trend following without any vol management. And so the issues with that are widely known. But then I was proposing that, okay, that the drawdowns and the volatility are uncomfortable, granted, but there's a big benefit to trading that way in that it's incredibly consistently profitable. Now, when I started, I wasn't trading nearly as well as I am now, and I didn't have as much knowledge, and my strategy wasn't as good as it is now. But I think we made money every year for the first 13 years. And I think that when we did our back test in 2006, we decided we needed to trade longer term, take away any kind of anything that wasn't necessary. So one entry, one exit, and a stop loss. And when we did the back test in 2006, we found that those simple trend following systems made money every single year in the back test. Okay. And some of those were probably 1%. Okay. So you get where I'm coming from. Not too bad, but you can't rely totally on this back test. And so it seems that if you're willing to allow for a lot of volatility and not smoothing your returns, the computer says, okay, if you're willing to do that, then I will give you this one thing. You'll be you'll be profitable. It may just be 0.5% very frequently. Like every year, you have a good chance of making money. And I think when we started to see that not happen in after 2009, that maybe every other year we were losing money, then you're thinking, okay, something's up here. I've looked at this back test. I'm not trying to take too much away from it. I'm not going out and proclaiming that trade like this and you'll make money every year. But come on, now we're seeing, maybe small losses, but we're just not being consistent any longer. So, and of course, I would just write that off as that it's not a problem with the system so much as it's just like I said, this lack of long-term trends. There's nothing we can do if when we go through the analysis, I like going trade by trade, market by market. What am I seeing here? And we're just not seeing enough trends. But let's say that we do see trends, and we have seen trends since the fall of 2020. Great trends, probably the best trends I've ever seen in my entire life. Well, you made 60-some% in 1993, Jerry. So what gives? Well, risk adjusted. I used to trade a lot bigger. I don't like that word, risk adjusted. That term, that's a devious term. But adjusted for leverage. I traded a lot larger, but I would have made 60% in the past 3 years, every year, if I would have traded that large in 2020, 2021, and this year. Okay, so let's say, for instance, so you're a CTA and you're hearing and you're reading about all these traders. The whole industry is making money except you. Then, what's going on here? So I'm going to go through each of these big trends one by one and see what my system is doing. Is it a question of I'm trading too short term and I'm keep getting bounced out of these trends, only to have to get right back in days or weeks later at new highs? So you're trading too short term. I'm not trading too short term. I'm hanging in there. I'm not getting bounced out of these trades. But when it turns around, I'm giving back almost all the profit. Okay, you're trading too long term. Okay. So I think you can examine whether it's working or not by looking at these long-term trends, if they're there, and you're not participating, you're not profiting like everyone else is. And then, of course, it could be a situation of where on the losing trades, your stop loss is too close. Your win percentage is 10%, 20%. You keep getting whipsawed. So I guess my point is I would go very granular and go through market by market and see what's happening and see why my relative performance is not very good. Or maybe this is happening to every trader, every trend follower. In the future, maybe we'll see, hey, there is so many big trends out there, and the vol management's not capturing them. The long-term trend following is not capturing them. And then we're in a heap of trouble. We're in big trouble when we're seeing a proliferation of trends, and yet the CTA as an industry is unable to profit. So this is how I look at it and how I approach. I mean, I've rifled through 200, 300 markets every day with my channel breakouts overlaid on top, sort of just like seeing what's going on and seeing how my systems are handling these trends. I don't discount the possibility that it could all just evolve into being lucky. I wouldn't say so now, but in the future, it could be that it's just random luck who profits and who chose the right parameter because the game is over.
There's one thing that just came to mind, and I just wanted to share that the catching of outliers in trend following basically is not a common phenomenon. As in, like again, the outliers are not always as frequent. So, in order when you want to catch the outlier and the outlier is common, you need to be sure your system is ready. Now, one of the points that Jerry just highlighted was obviously your settings or your strategy, your ATR, everything should kind of be in a good way. Like you shouldn't be too long term, not too short term. So, and then the infrequentness of the outliers means that you have less chances of getting it right than as opposed to when you do a mean reverting strategy when you kind of win all the time. So if let's say me, I get my strategy right, but I have all the wrong settings. It's very and the outliers are infrequent. It will be a hard time for me to catch that my system is not doing the right thing, unless you're doing the back test, of course. But because of the infrequent outliers, it takes a longer time for you to figure out, like, okay, maybe my ATR is not there correctly, or maybe I'm too short term because those outliers are not as frequent. So this is something that may be a disadvantage in this strategy, but something that needs to be taken into account, of course.
Jerry said that trend following improves even bad ideas. I like this very much. I appreciate this much. And I want to say that even some trend following elements improve and bad ideas and can be better than a lot of ideas that a lot of people think to be good, but it's not good. Because even short-term, I was a trend following trader, I have said it. Even if you are a short-term trader, a momentum trader, and you will catch this outlier, you will see this outlier, you will trade in this outlier. Of course, you will not catch the outlier in such effective way as a long-term trend follower trader will do. But you will not lose from this outlier, and you will catch part of the trend. Of course, it will be whipsawed situation, and because of this whipsawed, part of your profit will be not a profit, so will be lost. But if you are a trend follower, if you apply trend following elements to this process, even in not the best way, not the classical way of trend following, of course, it will not such good as if you are classical trend following. It will be better than to lose all this or a lot of money if you are less robust on your maybe mean reversion system that are, I think, less robust, or you're a discretionary trader and you are wrong in your prediction. Even a little part of a trend following elements will improve. I think so.
If I didn't know, I think we give off so many good hints of what it looks like. Like, unfortunately, I try to keep hammering on this idea that successful, good trading is just really painful. Seek out pain and discomfort and drawdowns and volatility. You cannot do too much of that. You know, I think that no one in trend following trading heaven or the club, whatever, is going to call you over and say, I want all of these people. I have a list of all of these people who were trend following, who held on to their profits too long. They were too comfortable with volatility. No, we're all humans. It's not going to occur. It's almost impossible for you to be too long term, too patient with these trends, and be too forgiving of this volatility. We all want to get out very quickly and give these profits back. We all want this smoothness. It just doesn't work. And it doesn't work nearly as well. And we need to force ourselves to understand that, you've got to hold on to these trades. You don't know anything about the trade. There's nothing you can say about this trade until your exit gets hit. Everything that happens in between the entry and exit is noise and disinformation, and it's tempting to make you do a trade. So holding on to these trades, I've told people my average holding period is over a year, and I think my average holding period for a loss, it's super long. It's not like a few weeks. So my stops are so far away from the market. My trailing stop, my stop loss. I look at the profit I make. I have a list of all my trades and all my systems. Every day I look at the max profit in that trade, look at the current profit, and then I look at how much profit I could lose if it goes to my exit. This is a scary report. I don't look at it often. It's just too crazy. You don't want to see what could happen because you've relied upon this back test and this computer, and then your experience. You've made money trading these systems, and you want to rely upon those. And when you get that research report back, you're like, oh my God, this is great. This is going to be easy. I'm going to make so much money. And then on a daily basis, what do you care about? All you care about is that these current trades, in this current month, and these clients are going to be screaming if you let profits turn into losses. And this is what the computer says. Yeah, if you let profits turn into losses, if all you care about is following these rules, then yeah, I'll give you this money. But if you want to smooth it out, manipulate it, care about the current profit in the current week, in the current month, I don't know, you're going to have rough sledding. And I think that this is this attitude that you need to have going into this battle and this war to try to survive, versus trying in researching ways to make life ease, comfort, and pleasure, because we all want that. But I think embracing the opposite is going to put you on a better path.
I was gonna say, I think we did advocate, or a lot of people said trend following is a good thing for long term, as in long term time frame is good for trend following, and short term is not so good. What I also realized is that the same way we are saying our strategies need to be long term, our mindset also needs to be long term. Because it seems like, and I'm not saying that's what it is, but it seems like a lot of people are still caught up in the trade by trade basis way of looking at things, rather than looking at the overall performance in a longer term time perspective. So I do think, same way we have a strategy, we also need to think about the mindset that we put behind those strategies. That strategy also needs to be long term. So I'm advocating for having a long term strategy, but also a long term mindset that goes with that strategy. Otherwise, you're confusing. You have a short term mindset, but you have a long term strategy, and that doesn't work together, right? So that's one point I wanted to highlight.
I love that. That's really good. I hadn't thought about it that way, but I think that is so true. And another thing I wanted to mention today, which we never got to, but is that not only you have to have a trend following mentality as well. Like I just felt like over the years, I would meet people, especially from the stock world, and they would want me to conform to their normal. And this is how we do it. And I refuse to do that. And for us, going from our strategy into the stock world is much easier than them going from their stock world into our world. Um, so, but I think you need to put up a fight against conformity and force everything that you see. And adding stocks to your trend following portfolio was something that I did, and it was something I had to learn about. And how was I going to do this? But I refused to do it any other way than how I treated the currencies and the commodities and the bond futures. I forced my mentality and my strategy to make the stocks fit in. And I never succumbed to these arguments of better ways of doing things because it's a stock, no, our way, my way is the best way. You need to conform to me. I'm going to put these stocks in the trend following box, and I'm going to trade them with trend. When I would talk to my friends, who are these friends? Well, you can guess who they are. And I would say to them, I'm going to add single stocks to my trend following. They were like, why? What are you doing? And then they would immediately say, and these were diehard trend followers, and they would say, oh, well, I might do that as well, but then I'm going to add in fundamental analysis or other types of quantitative analysis that's not price only, not price trend following. And I was like, what is wrong with you people? Why? I just never understood that. We need to be in this cult-like and refuse trend following cult-like worldview and refuse to conform to the way others want us to be. So it's not ever going to be stock only. It's never. I reject totally long only stocks. Long only
Yes,
anything.
well said, G-Rivel and Jerry. I totally agree. So this is like applies to anything in life. So we have to step back and look at the big pictures. And also, yeah, Jerry, you're right. We have to fight against conformity means stay away from the herd. Thank you.
No, by the way, I was thinking a lot about when some people said to me, and of course, people often say to me that I'm not perfect in my earning ability, maybe. And I want to say yes, that it's easier for me to be more perfect as they think, and to be liked by people like that. People who do so, to be clearly, for me, it's I'm in not the on the easiest side, to be more clear, but I have chosen my way. And firstly, it was only research. It was only a lot of research first years, and I was reading. I tried to read, to listen something, and I understood that I don't feel that I want to be on the side that people promote. And only when I have found Neil's podcast, Neil, Jerry, and Maurice, it was feeling in my heart that it was. When I was doing my research, I had also a lot of questions, and I didn't know, to be honest, how to answer these questions. And I believed that sooner or later, maybe in 10 years, maybe in 20 years, I will find the answer. And it was very, very important. And in this podcast and Top Trades Unplugged, I have found all the answers that I have, all the answers I have found, even more than that. And I was feeling in my heart that I believe, and I'm more concerned even in my trend following strategy, but of course I did the corrections. I became long-term trader. I became more diversification trader. I became less risk trader, and it made me more perfect. And but I want to say that really some people say that there is more perfect ways to have a lot of profit, to be short term, to be low target, to be buy and hold guy or something like that. And I want to say that it's not my way, it's not my choice. At least I have found that I don't want to go this path. I have found for me I have 15 years journey, and for this 15 year from 2007, and I have found that I want to be only 100% systematic, classical trend follower and nothing else. Here's my point.
There's one more thing that I want to say. I keep saying one more thing, but there keeps being more items. For me personally, if there was another strategy that worked better, I would go for that strategy. So I'm trying to stay open minded. The only thing is I haven't found that strategy. So and I don't want to be the person that keeps hopping over different strategies all the time, because that's not consistent. But at, as I see it, trend following is the way. That doesn't mean that there's no other way to skin the cat. Like there might be other strategies that obviously work as well. That's why you have examples like, Jim Simons, and all different examples that people use in different type of strategies. But from what I can see personally, I think this is the way, and I'll stick to it until I find something else. But I don't think I will find something else. So that's the way I'm trying to navigate this world. Just sticking to what it is until something proves it not to not be viable. Um, Although I don't think so, I try to stay open-minded.
And I was thinking yesterday when I was on that other podcast that I was talking about, is that our first and highest calling is really not to be trend followers.
Nice to meet you.
It's really to be systematic trading and follow rules and do the legitimate, scientific, robust back test and come up with these rules. And that's really what we're doing. I really, once again, I keep harping on this same subject. I really don't like when, I think people are off base when they look at the trades and they say, well, the trend has changed, or it's no longer going up. How can you consider this to still be in an uptrend, or it's in a downtrend? It's all these subjective things where, in fact, I trade 4 systems, and sometimes system 1 is long and system 4 can be short. So what do you mean? I don't look at this stuff in terms of this subjective, the trend is up, the trend is down. I'm following my system. It's rules-based. I've done the back test. And I guess if you wanted me to describe it to you, it is trend following, price trend following, and diversified, etc. But we're really systematic traders willing to trade any methodology that is profitable and that gives us a good chance of making money, but also helps us preserve capital or doesn't put all of our capital at risk. So then what elements does it have in order to do that? It's going to be diversified, longs and shorts, small losses. Okay, so then every system under the sun that has the characteristics that you need, profitable, and is going to keep you in the trading game in the long term, then something other than trend following, what characteristics are you willing to accept? It's going to take large losses. It's not going to do shorts. It's not going to be very diversified. I just don't know. I mean, I think anything that other than trend following that you may find, it might have a lot of elements of trend following, because it's these elements of trend following that keep us safe and still allow us to make profit. So I too am waiting and willing and want to be open-minded, but I just don't see, other than different look-back periods and different parameters, I wouldn't rule out the possibility that using, short-term trend following, day trading with trend. I don't know. Does it work? I don't know.
And I want to say here that a few years ago, I fully agree with Jerry on this, and my 15-year journey shows the same. Of course, Jerry has a more big journey. He has 39 journey years, but I'm only 15. But I'm talking about that a few years ago in 2018, one young trader from London gave me as a present a secret system from his firm, and he said it's a secret short-term system, pattern recognition short-term system, and he said please don't show it to anyone, it's a secret and I can have a problem in my company that I shared this. And I say okay, but I want to say now that even if I wanted to share with somebody with the system, I can't do it because I don't remember the system at all. And I did a back test, and in 1 or 2 years, it was perfect. Yes, it was perfect. I saw very interesting, maybe not interesting approach, but I did understand what is the logic behind this. I really did not understand this, but I saw that results, performance really good in 1 year. And there are that there is nothing more good, there's nothing better than classical trend following, and if we even trade something, if we even backtest something that looks incredibly good, we must understand the logic behind it. We must understand what will be if the environment will be changed, and so on and so forth, etc. Here is my point.
Okay, I'm going to have to go off and do some other things this morning. I have some pets to take care of, but it's been very enlightening and fun, and I'm glad we got Mike Harris on. I've been wanting to get Mike to join us for a long time. He comes at things from a different perspective, and it will be fun to get him back and on the same time when Richard can join us. So I think Richard will be back next week. So it's been fun, and I appreciate everybody attending, and see you next Friday at 8 a.m. Eastern Time. Have a good weekend, everyone.
Thank you. Have a great weekend.
Everybody.
Bye.